So I'm thinking about doing a few more economics videos soon. So it's probably good. My next few videos will be about. Right now, I want to discuss money and the economics of money, which mainly because it's an area where my views have shifted recently, and I want to discuss that. I was formerly an advocate of what might be called debt-free money. Um, the view that's been put forward mainly by Steve Zarlinga and Ellen Brown, and there's a channel on YouTube. I think it's called Coffee with Joe, something like that advocates that view. But there's basically what they advocate is a system of full reserve banking and government-issued debt-free money. And I'll explain what that involves and what they see as the problem, and I'll explain why that's why the problem they perceive is not the real problem. So basically, they start with what's called the money multiplier, which is a part of any standard economics textbook about money. The idea is, say you have $100 deposited in a bank, and the reserve requirement is 10%. So the bank can then lend 90% of their deposits out. So they lend out $90. But the $90 doesn't come out of your $100. It's added on top of the $100. So they actually create the $90 out of thin air. So then the deposits are not, are not not $10. It's actually $190 because they put the $90 in both the assets and liabilities column. And then so then they can lend out another 90% of $90 on top of that until until you get this sort of curve of the amount of money that can be created out of the original $100. And as I said, this is the standard economic view, and it's the starting point of this debt-free money critique. Because they say the problem is that, well, the banks create the principal through this process, but they don't create the interest. And so what you have is this sort of, in order to get the interest, then you have to make new loans, and therefore, you get this ever-expanding debt bubble of loans that eventually can't be paid off, and then the system crashes, and that's how they explain the business cycle. And so instead they advocate a system of full reserve banking, so that banks no longer have the ability to create money, and then government, rather than borrowing money, just creates money and spins it into existence, and then that circulates through the economy. And the idea is that because the Fed currently tries to regulate the money supply through regulating the amount of deposits and interest rates and whatnot, there's no reason the government couldn't do that as well, and the money supply that the economy needs. And this is all consistent with the mainstream neoclassical view of money. The problem is that view is wrong. The money multiplier actually doesn't exist. See, the thing is, when they say that banks create money out of nothing, they're actually more right than they realize, because loans don't come out of deposits. Deposits come out of loans. Banks, so in our $100 example, the bank could create $1,000 with $100 in deposits, and then there's $1,000 circulating in the economy, and then they borrow from another bank to get the to get the reserves to back it up. So basically the process is banks create the loan, which creates the deposits in the process, and then they seek reserves later. Um, and so actually, there's no reason why I wouldn't expect this to happen in a full reserve economy. Even if it was a 100% reserve requirement, the banks could still expand the money supply, and then get the reserves they need out of the new money supply. And so, one consequence of that is to realize that the Fed actually doesn't have that much control over the money supply. They don't actually, none at all, really. The money supply is driven by the demand for loans. It is market driven, and so that means that that actually trying to have the government determine what the money supply is actually has a kind of hubris that goes along with most so that goes the way of most socialist central planning. It's basically except for what's called the calculation problem, and it's likely to lead to either inflation or deflation, but not a steady money supply. Now, as for the problem of the sort of impossible contract view, that you need an ever expanding bubble of loans that will inevitably collapse. That is based on mistaking stocks and flows. The stock would be like the principle of the loan would be a stock. That's the it's created in one fell swoop, and it's from that you spend it into the economy and try to create wealth. But then the flow is the rate of loans each year. So yes, the interest has to be paid back with new loans, but that doesn't mean that the number of loans has to increase each year. You can have a steady rate of loans, and thus have like a steady debt to GDP ratio. You can have a 20% debt to GDP ratio, and pay off all the interest. As long as loans keep getting made, and it doesn't require the economy to grow, unlike what the advocates, proponents of this view believe. Now this is you can be forgiven for making this mistake because a lot of mainstream economists do. There was one economist named Mikhail Kalecki who once jokingly said that he figured out what economics is the science of confusing stocks with flows. So that you have to put the time element into that in order to understand the fallacy of that argument. So implications for debt money. As I said, there's the calculation problem. That we have the illusion right now that the Fed controls the money supply, and they really don't. It's actually set by the market. The market there's a market level of demand for loans, and basically trying to have the government replace that demand. Having the government try to calculate that demand all once is bound for failure. On the other hand, as I said, even under 100% reserve ratio, banks would still continue to create money. So maybe the fact that these reformers are ignorant of the system I described, which is called endogenous money, that is, that banks create that the money supply is set endogenously by the market. Maybe that is their saving grace, is the fact that they don't know what they're doing. But so other than that, that means there's no real reason to get rid of fractional reserve lending, because no matter what the reserve ratio is, banks will still create money as the market demands. So now, one aspect of what they advocate, I do agree with, which is the idea that government can create the money it needs for its spending, rather than borrowing it from China or what have you. there's no reason the government can't just create its own money for infrastructure, for government, for paying its employees, for all that, and no reason why it should have to borrow it from the Fed either. So that's I think that basically you should leave money to the government and credit to the banks. Let banks continue to create credit because that's a service that the economy needs. And so this also means that the sort of impossible contract theory does not explain the business cycle. And I think in another video I'm going to explain what I think does explain the business cycle, what does cause these economic bubbles to form, and how we can address that problem. So thanks for listening. Peace.